Welcome back to Wealth Webinar, everybody. Thank you for being here the day before Thanksgiving. So we are extremely thankful that each and every single one of you are here because we know that there's a lot of things you could be doing with your time. You could be out there getting your turkey. You could be getting ready. You could be blowing away outside in this crazy windstorm that we're having that sounds like pretty soon my studio is going to take off into the air. But nonetheless, here you are the day before Thanksgiving to learn. And you know what? We want to really kind of make this episode all about you. And we're going to do something a little bit different. We're going to teach you some things about IBC, the infinite banking concept. And to take that one step further is a process of taking back the banking functions in your life. If that isn't something to be thankful for, well, then I don't know. But what we're going to do, we're going to talk about how. We're actually going to not just talk about how, but we're going to talk about the 10 most powerful things IBC does and why we should be thankful for those. But let me start with one thing before we even get into that. Every time we do this, we get, 100 to 200 people. Today will probably be light because, well, it's a holiday. A lot of people are traveling to family, doing various things. But I want to just give a shout out to all the folks who are here for the very first time. So we're really thankful for each and every single one of you. This morning, I was meeting with Dave in our office, and Dave works with my CFO. Dave works on all of our personal investing, tracks all that stuff, and does a whole bunch of stuff for us, keeps us in line. But, Dave's also helped me with some personal, like planning stuff. And he gave me this, and I thought this was a really good way to start, and I want to read this. He was describing the difference in the perspective between the wisdom versus knowledge. And I'm sure most of you know this, but knowledge and wisdom are two very different things. Knowledge is the accumulation of facts. How this came about is this morning on WTF, we were spitting out a bunch of facts, a bunch of knowledge, if you will, things that I, was talking about and James was talking about and Stephen was talking about within the economy and the markets and everything else. And we were just going back and forth. It was a fun episode today, but we were just going back and forth, shooting out knowledge. Okay, that was knowledge. It's great. It makes you seem really smart. You leave it and you're like, wow, I know a lot about the economy. I can't believe I knew what was going on in Japan with interest rates and how that's going to collapse the markets. But that's just knowledge. Then there's wisdom. Wisdom is the proper application of that knowledge that I just mentioned through a God-centered perspective. Knowledge is all about what you know, but wisdom is about how you live that knowledge out. I thought that was really interesting. He went on to define knowledge as the acquisition of facts, truth, and information. The source can be through study, experience, and hearing of God's word, if you will, and the nature of foundation, but not sufficient on its own. And I think that's so relevant for what we're going to be talking about today. Knowledge about infinite banking is just not sufficient on its own. You need a lot more. You need the wisdom, but it can be seen as mind-filling activity, right? When we get knowledge, when we read books and we get all this knowledge, our mind gets full. But let me define wisdom, and then we're going to talk about the relationship about the two, and then we're going to dive into this. Wisdom is the ability to use knowledge correctly in life, making sound judgments and good decision. And the only way you do that is by experiencing things or working with somebody that has wisdom that passes it down to you. I know almost every one of you on here has created wisdom in your life through failure, right? We've all failed at something. We've invested in something that didn't work the way we wanted. We've partnered in something that just wasn't what we thought it was going to be. Something in our life has happened, and because of that, we learned, but we developed wisdom because of the experience. We had to go through it. We couldn't just watch it. You had to actually go through it to gain that wisdom. The source is a gift from God that comes from applying knowledge with moral discernment and godly perspective, and the nature transforms your heart, your habits, and it guides your actions to reshape your life. It is seen as a light in your journey. The light at the end of the tunnel is how I like it. And then he said the relationship between the two, and I thought this was the cat's meow, if you will. Wisdom is the practical application of knowledge. Knowledge can exist without wisdom, but wisdom requires knowledge to be applied. Let me just reread that. Knowledge can exist without wisdom. You can have knowledge, but not wisdom. But wisdom requires knowledge to be applied. And then it basically goes on to just say that simply acquiring knowledge, you got to move beyond simply acquiring knowledge. So this webinar is going to give you knowledge, but you've got to move beyond that. You have to apply that knowledge in your life to solve some problem, to guide your life. And that's exactly what this is all framed up on today. And it transforms your life, showing you through your actions. Okay? So with that, as we dive into this, some of the things that, and I've just got some notes here. I just want to make sure I stay on topic because me and Stephen are just going to go back and forth about the 10 different things that we're thankful for that we teach. Now, in that, we're just going to say what we're thankful for, but how you're going to learn is because you're going to learn through wisdom we have acquired by doing this. And I think this is going to be super fun. Goes on to say, most people don't talk about money with gratitude. It's usually about stress. It's usually about fear. It's usually about shame. Every time we talk about money, for most people, if you have a discussion about money, it's usually stress, fear, and shame. It is not gratitude. Do we think about money and are we grateful for what we have? No, we always seem to want more, right? It's like more. Oh, I make this, but I need more to do that, right? So it's always coming from that place of stress, fear, or shame. We need to move our thought and our talk with ourselves. Because listen, how you talk to yourself, forget about how you talk to me, Stephen, Tess, or anybody else. It's about how we talk to ourselves when no one's around, when we're staring in the mirror, and we're having those hard discussions with ourselves. That is what really matters. When those moments happen, you need to talk about money and you need to be grateful about what money is, what money does for you. Because money is just a tool, but you need to be grateful for that tool. Okay. If you talk about money in the same context as fear or shame or stress, guess what comes in your life? Fear, shame, and stress. It's funny how that works, isn't it? I could learn a lot more about this. And Steven's probably sitting there like, oh, this dude's talking like he knows what he's talking about. No, damn well, I get stressed out. I get stressed about money. I get stressed about capital outlays for big things that we're creating, as you were alluding, Steven. And then what happens? Well, more fear comes into my life. But if I was just grateful for, oh my God, I'm so grateful for what we can do today, then more of that happens. It's just interesting. What if your financial life could actually feel peaceful? What if your financial life could feel empowered? And what if your financial life was aligned with what matters most? What matters most to you? So, this is the day before Thanksgiving. So we're going to go into a day where really we should spend that entire day, that entire day being thankful. Thankful for the people who are around, even if you're around that annoying aunt. I got those too. Be thankful that they're annoying. I don't know. Be thankful for something. Be thankful for the food that you're eating. Okay, even if the food sucks, even if it's like National Lampoon's Christmas Vacation where he goes to cut into that turkey and he just be thankful. Okay, and I think when we talk about the infinite banking concepts, we have to talk about what the infinite banking concepts has done for us. I can go through and I can talk to a bunch of people on here, whether it's Tess or Dex or Shane, and I know what IBC has done for them. I know the different things that it has done to solve problems in their life or change their life or catapult their life. Like those are all things to really, really be thankful. And we've done this for thousands of people. Over 6,000, if I'm not mistaken, between the two companies, over 6,000 people we have helped with their finances through this simple process called the infinite banking concepts. So in today, that's what we're going to do. We're not going to try to convince you that this works. We're not going to try to convince you that this might make sense for you. We're not going to try to pitch you anything. We're simply going to go through and talk about the different things, the 10 things, because we just boiled it down to 10 things that we're grateful for about the IBC system. That's it. So, Stephen, should I kick this thing off?
I love it, man. Let's do it.
I'm also thankful Lisa Menconi is with us. She's done so much. Her whole life has transformed. And I'm sure I'm missing out on a lot of the folks that I should be naming. I'm just trying to kind of get through this, and I just picked a couple. But yes, thank you for calling me out. Lisa, I love that. We are thankful for you. But here's the first thing. When we talk about the 10 things that we're thankful for, the number one thing is that we don't have to ask permission to use our own money. Now, this might come as a surprise to some of you. Think about that. You do not need to ask permission to use your own money. Now, I know you probably don't know what that means, but let's go in and let's talk about a bank. Let's say you got a lot of money at a bank. I don't know, call it $1 million. Let's go big. And you have something that you're going to do. You're going to invest in a company that is aligned with you, that you know, like, and understand, and you need $1 million. So you go to that bank and you want to take that $1 million out. Now, I don't know if anyone's ever done this. Doesn't have to be a million, could be 100,000, could probably be anything more than 10 grand. Does the bank just give you your $1 million? It's your money, remember? Well, if you actually remember what you signed and read the fine print, it isn't your money. You gave control over to the bank of that $1 million. So are they in the right to say that they can't give you your $1 million? Are they in the right to ask you to fill out additional forms? Are they in the right to ask you what you need your money back for? If you read the small print, I guess you could say they are, which means you're not in control of it, which means you're technically asking permission to use your own money. Even though you worked for that money, you put the blood, sweat, and tears in to whatever it was that got you that $1 million or 100,000 or 10,000. But yet the bank is going to ask you why you need this. And then they're going to ask you what you're going to use it for. And then they're going to ask you to fill out a form and another form. And then they're going to tell you, well, we can't give it all to you now. We don't have that much money here. And you look back and you see the vault and you're like, well, what's in there? Not money. That's all you need to know. Your money's not in the vault. Your money's out working for the bank, okay? It's out there making little pennies and nickels and dimes and quarters and dollars. It's working for them, making 400 to 1,300% more than they are. Okay, hold on. Let's go through some of the other places you think you don't need permission to use. How about your 401k? If you need money from your 401k, let's talk about why you need to ask permission. First off, the government, the IRS, says that you can't use your 401k money until you're 59 and a half years old. And if you do, well, they're going to ask questions because, well, if you're taking it out just to take it out, well, you got to pay 10%. It's a toll. It's a fee. It's a whatever you want to call it. It's a 10% penalty for taking your money that you worked for out of your 401k account. So indeed, you do need to ask permission. You also need to ask permission from the 401k administrator, whether it be Principal, Vanguard, Fidelity, any of those. You have to ask them permission. You actually have to fill forms out and everything else. Okay, and on those forms, you got to give a whole bunch of questions. So do you need to ask permission to take your money? You sure do. The IRS, the plan administrator, the bank, they all require you to ask permission to use your own money. And in some cases, you got to give them a cut. But with the infinite banking policies that we design, which are specially designed and engineered whole life insurance policies built for high early cash value, do you need to ask permission? Because I've done this hundreds of times. And what I do is I log into my account, I go up there, I click loan, I do click a couple buttons. There's 4 of them to be precise. Like, what bank account would you like this money to go in? They do ask if it's part of a divorce decree, which I'm sure is something else. And there's 2 other questions. How much do you want? And I don't know, there's 1 other question. But none of them are like really infringing on my ability to get the money. And then when I do that, I tell it what account I want it to go to. I either fill a form out, I do it online if it's under 100,000 in most cases, and voila, 36 hours later, the money is in my account. Barring that you don't try to do this the day before Thanksgiving, the day before Christmas, then it takes like an extra day. And I think you all understand insurance companies are not open on Thanksgiving, Christmas, or any major holiday. But I think that's the neat thing. So if for some reason one of you had a family emergency and you needed $12,000 and you needed it by tomorrow, okay, you have options. Your 401k wouldn't be a good one. Maybe the bank will give you the 12 grand without asking permissions, but I can tell you your policy certainly would. And instead of it taking 36 hours, you could just tell them you want it wired. They do charge for the wire because there's a bank wire fee, but that money would make it in your account. And you didn't have to ask permission for it. You literally just had to direct where you wanted the flow of that money to go. So that's the one thing I like to think that I'm thankful for, is that I no longer need to ask permission from the bank, the 401k, the brokerage, the financial advisor who's going to be like, oh, well, what are you using the money for? Is it any of your business? Well, kind of, I'm your financial advisor. Well, I guess he's right, or she's right. Because if they're your fiduciary, I guess it would make sense that they advise you on it, but the money is leaving their control. So you got to just weigh these things out. Stephen, do you want to take the next one? I think this one's good. Thankful about compounding interest.
I love it, man. I mean, when I first learned about infinite banking in 2019, I truly thought it was a gimmick. And that just comes from a past of being in an industry where there's a lot of nefarious characters. And what I mean by that is I spent about 12 to 13 years leading up to 2019 in the financial education and seminar space, specifically in real estate investing. And what I learned is in that space, a lot of the gurus that you see out there are very fake. They will say something that they don't truly believe in. They'll say something because of the financials of it, because they make a lot of money saying it, because they make a lot of money promoting it, but it's not something they actually do. And quite frankly, when I first met Chris and Brent Kessler, specifically with infinite banking, I thought it was a gimmick. I thought it was one of those things where, hey, we're using this just to promote, and this is what these guys are doing. And I literally brushed it off. Like I was like, listen, you guys do whatever you think with this. And I've told the story before, so you guys have heard it. But then I had some time at the beginning of 2020 to actually, sit down for a second and learn about infinite banking and what it actually is. And I started reading the books and I started watching the trainings and I started following Nelson Nash. And, and very quickly I learned, holy shit, like this is one of the most legitimate things ever out there. Because sometimes you see these presentations, they feel gimmicky, but I realized very quickly it's not. When it comes to infinite banking, it's built on a specially designed whole life insurance policy. Whole life insurance, I understood from being a personal financial advisor back in the day. And so it made all the sense. It's guaranteed. And then once I learned how you can actually design and use these whole life policies the way we do for becoming your own bank to do infinite banking, I was like, oh my gosh, this is unbelievable. And then I got to know Brent Kessler better. I got to know Chris Naugle better. And I got to realize they are the opposite of what a lot of these gurus out there that you see all over the place are. Chris and Brent are very real. They only teach and talk about and promote what they personally do in their own lives. And that was new for me. Like I had not really been around people like that in the past. So it was very eye-opening. And so the more I learned about what infinite banking could do, the more it just opened my eyes to just how powerful it is and how many incredible financial strategies it incorporates into one vehicle. And one of those, Chris, you just mentioned is compounding interest. When it comes to compounding interest, and Albert Einstein, I don't know if he actually said this, he's coined or he's credited with coming up with this, but they say Albert Einstein called compounding interest the eighth wonder of the world. And Albert Einstein said, hey, this is the eighth wonder of the world. Those who understand to use it, those who don't pay it. And it's so true. And so let me just give you a quick example of what compounding interest is. And then I'll show you an example in real life of what it can do. Okay. So, all right. So you guys, if you're new here, this might be good. If you've been around, you've probably seen this before. So I'll go through it pretty quickly. But can you make money earning 4% while paying 6%? Well, on the surface, obviously you would think no way, right? There's no way that that's possible. But this is where understanding interest and compounding interest becomes so important. And this is really the foundation for how infinite banking works, how the money flows through these policies. This is literally the foundation of all of that. All right. So I'll explain this in a way that we all understand when it comes to buying a vehicle. Okay. So let's just say you want to go buy a vehicle for $25,000. Okay. So there's a couple different ways you can do this, but let's just say that you've been saving money in a savings account at Wells Fargo, at your bank, Wells Fargo, for the past couple of years. All right. So you got $25,000 sitting in that bank account at Wells Fargo. So you walk into the bank, you say, hi, walk up to the counter. I'd like to withdraw $25,000 from my savings account. The banker's going to look at you and say, well, why do you want to withdraw that money? What are you going to use it for? They're going to ask you a million questions. They probably won't actually have $25,000 to cash to give you right then and there. But regardless of all of that put aside, what's going to happen is that teller is going to go get a manager. The manager is going to come back over to you and they're going to say, hi, I understand you want to take $25,000 out of your savings account. Yes, that's right. I'd like to buy a car. The manager would say, all right, well, what if I present with you a second option? What if I offer you a loan from our bank to go purchase that same car for $25,000, right? And so you say, okay. And the banker says, and what I'm going to do is I'm going to use your collateral the $25,000 in your savings account that you say, I'm going to use that as collateral to give you that loan so you can go buy the car. So that way, you still have your $25,000 that you've worked so hard to save up. It's still in your bank account, and you're able to go ahead and go purchase that car like you want to. And you look at the banker and you say, actually, that sounds good because if I take my cash right now from my savings account and I go buy that car, that money's gone from my life forever, forever and ever. I'm never going to see it again. Sure, I have the car, but that money's gone. But you're telling me I can keep that money in my account and still go buy the car. That makes sense. All right. And then you say, look at it and you say, all right, well, what are you going to charge me? I'm going to pay interest on this, right? And they say, yeah. So what are you going to charge me to get that loan to go buy the car? And they say, okay, well, we're going to charge you 6% on this auto loan. And you say, okay, well, how much is my money making in my savings account right now? And the banker says, well, it's earning 4%. And you look at that banker and you look down and you see a bowl full of lollipops sitting there. And those lollipops, you guys all know what they are, right? What is the name on the lollipops in every bank that you go to? Dum-dums, right? The bankers think we're all dum-dums. I really think that's why they have those lollipops there. But nonetheless, you look at the banker, you look at the dum-dum lollipops, you look back up at the banker, and you say, listen, I know you think I'm a dum-dum, but I know I'm not going to pay you 6% while you're paying me 4%. I'm going to lose money. Just give me my money so I can go buy the car. And the banker says, hold on, hold on, hold on. Let me explain to you how interest works. All right. So this is what we're getting at here. So the $25,000 that you're going to pay for that auto loan, let's just say it's a 5-year loan. That's pretty common, right? So over the next 60 months, you're going to pay 6% a year on this auto loan. But what happens with an auto loan? Well, you have a $25,000 balance to start, but what happens each month? You start making monthly payments. So that balance begins to drop each month that you make a monthly payment. Well, the way that these simple interest loans work is they're going to charge you 6% based off the balance of that loan. So each year, the balance is going to be less, meaning you're paying less each year in interest. So at the end of those 5 years, that $25,000 will become about $29,000. So you're going to pay about $4,000 in interest. So there's about a $4,000 net right there. All right, but look what's going on over here in that savings account. See, this is the opposite. Even though it's only 4%, you're paying 6, but you're only earning 4%. What is this? What is going on in that savings account? Well, that money's sitting in there over the same 5-year period, growing. So each year, the balance that 4% is growing on is a larger amount. So the second year, it might be 26,000. The third year, it might be 27,500, but each year it's bigger and bigger. So at the end of the same 5 years, that same $25,000 at 2% less actually grows to be a larger amount. You're actually netting a little over $5,500 where you net a little over 4,000 over here. So if we would have listened to that banker, understood how interest works, especially the power of compounding interest, we actually would have made a little over $1,500 by paying 6% while only earning 4%. Does that make sense to everybody? And here's the other cool thing is, and one other example I wanted to share is if I was going to offer you a penny today that doubles every day for the next month, for the next 30 days, or I was going to give you $1 million today that you could have, what would you take? A penny or $1 million? Well, if you took the $1 million, you would have left several $1 million on the table because that penny doubling every day for a month, 1 month, 30 days, that becomes something like $4.6 million or something. And so if you guys know the math, you can share it with me, but it's something like over $4 or $5 million. And that is compounding returns. That's compounding growth. That's why somebody like Albert Einstein is coining the phrase, it's the 8th wonder of the world, because when you understand the power of compounding returns, it's incredible how much growth you can get on your money. And that's exactly what these infinite banking whole life guaranteed policies do. And I'll talk about how I'm thankful for those guarantees, especially in volatile times like we live in today at the end of 2025, going into 2026. I'll talk about as my family grows and as I get older, how important it is to have that legacy aspect with the death benefit on it and all these different things in this simple whole life policy that I'm thankful for. But I wanted to start out with compounding interest because at the end of the day, that's exactly how these policies function. We put our money into the policy. All that money that goes into there, it grows and compounds every year for the rest of my life until the day I die. And simultaneously, I can pull that money out and I can use it for other things in my life, whether that's paying down debt, that's buying things like vehicles and recapturing the money. It's investing and growing my wealth. That money's always in that policy compounding and growing. When you understand the power of compounding interest, a lot of this is going to start to click. All right, Chris, that was a little longer than I wanted, but hopefully that was good.
That's all right. It was great, actually. So one of the things I want to do now is I kind of want to just go into where me and Steven are going, kind of going back and forth because we can share a lot of similarities here between these next couple of things. And the other thing too that I got thinking about when we first started talking about today's topic of being thankful for IBC was, I can't not think about, my daughter. She's 5.5 years old now. When she was 6 months old, we started her very first policy. It wasn't a big policy. It was $5,000 per year that we put into that. And that is the only policy that I pay annually, like I was mentioning early. But when I think about it, that money that I'm putting in there, right? A lot of times people will save money for their kids. And I had a guy at the dealership the other day who I know, Dylan, came up to me and kind of pulled me aside and he said, hey, because he just had a baby. He said, hey, my wife wants to set something up for our daughter. We were thinking about setting up a 529 plan and a Roth IRA, and he said maybe a brokerage account. And I said, well, why not set up a specially designed whole life policy that will do everything that all three of those accounts will do without any restrictions? And he'd really never heard of this concept, so hopefully it gives me the opportunity to show him what I'm about to show you. But think about this. People start 529 plans because they want to save for their child's college education. Totally understand. But if their child doesn't go to college, that money can only be used on another child going to school, or the parent has to go to college, right? So it's got restrictions where it's just for college. Then there's Coverdell plans, which open up private schooling, so you could use it for a child's private schooling. The only real advantage to a 529 is if you knew your child was going to go to, like, here I'm in New York. If I knew my child was going to go to a state SUNY school, and we did a New York 529 plan, we get some tax savings, state tax savings, which amounts to very, very little. But if I put $5,000 a year into a 529 plan, that means that Vivi has to go to college. It means that Vivi can't use that money down the line to buy her first car. I can't use that money to teach Vivi how to actually apply the banking concept in her life. Okay, so there's that. Then the Roth IRAs, right? So then I was thinking about that. All right, there's all sorts of restrictions with Roth IRAs. So you put money in this qualified plan. Yes, it's going to grow tax-free, which is the main reason why you'd put money in a Roth IRA for your child, is so that someday when they take that income out, it's tax-free. I know you can use up to the principal without any tax issues or anything like that prior to 59 and a half. But again, rules, and more rules to learn. And now we're really putting that money away for a much further into the future type of situation. Vivi was 6 months old, so now I got to wait. She's got to wait 59 years to really be able to use that money hypothetically without any real questions. But then, what if we just put that money into a stupid, specially designed whole life and we perform the infinite banking concepts? Let's just think about that. So I can do this without hurting Vivi's future, without hurting anything in my future, because now what I'm doing is creating a self-perpetuating system that will benefit Vivi not just once, not just twice, but throughout her entire life. Now, let me demonstrate that. I think is the best way to do this. So I'll share my screen. So this is Vivi's policy. There's nothing fancy about it. It was a policy we did at Mass Mutual. Here you go, $5,000. This is how much money we're putting in. And this is not even a policy designed for extreme high cash value. Hence, year one, I put 5 in, I only got 2285. This is actually built 60% to base because I knew Vivi was 6 months old. I couldn't think of anything Vivi would need in those first 10 years of the policy. So I wanted the policy to be more efficient in the later years than efficient in the short early years. So this is how I designed this. The whole thought, and it could go any which way, but let me just explain this. We could throw a car in there. So when Vivi turns 16 years old, let's just say here, she's got almost $100,000. Now I know that's 16 years into the future. So what kind of car can you get for $100,000 16 years from now? Probably a really nice one is what I would have to believe. But nonetheless, if she needed a car, I could teach Vivi how to go out and shop for a car. I could teach her all the tricks about going to dealerships, things I've learned, the wisdom I have gained by making mistake after mistake after mistake of buying cars and losing money on cars. By buying them wrong, this dealer wins, that dealer wins, I get screwed, I sell it and lose a bunch. We all know the story. Look, buying cars is awful. It's a hard game to win when buying a car, especially if you buy from a dealership. But in this game, I get to teach Vivi how to go out, find a car. I get to teach her how to be patient and how to kind of put off instant gratification for learning how to save some money. And we go from dealership to dealership to dealership once we identify the car she wants. And then we have each dealership battling for the business, for the best price. We don't tell them we're paying cash for the car. I just did a YouTube video on the things to do to buy a car and get the best deal. We teach her, or I teach her, or me and Larissa teach her, the absolute best negotiating tactic. So now we get one dealership to drop the price on the car, to come up with the best financing package for the car. So we go and we're now ready to buy that car. And then as the dealership thinks that they're going to get the financing on the car, because just so you all know, Shane can tell you this, dealerships make a lot of money in financing cars. They get paid like a spiff or whatever you want to call it. I can't think of the terminology. Shane will probably put it in the chat, but they get paid for the financing. It's points or spiffs or bonuses or whatever the heck they call it. Points, I guess you would call it. That's what Dex said. So now we're at that table. We've negotiated the price of the car. Okay. They negotiated it down because they wanted the business. Okay. So Vivi saw how now we saved $5,000 or whatever it is on that car over just if she had bought it from the first dealer. Now what we've done is we've had that same dealership run the financing options. 5-year, 3-year, 7-year. Hell, by then they probably got 15-year car loans. We have them run all these options and we have them shop for the best rate without pulling our credit. So they've got all these options laid out. And then when I teach Vivi, I say, Vivi, we're not going to use their financing because we're going to use your own bank. Remember, your bank has $99,000 in it. This car is only $50,000. So what we're going to do is take a loan from our bank. We're going to pay for this car. And we tell the dealership that we're paying cash for the car and they get upset, but they've already negotiated the deal for the price. They're locked and loaded. They can't go back on that. They know that they're kind of screwed themselves because they're not getting those points anymore, but who cares? Deal is done. So we pay that, we tell them we're paying cash. They're getting it already. But they've also given us some very important things that we needed. They showed us the absolute best financing rate in the marketplace. So I teach Vivi now, look at this financing company with Ally Bank is at 5% interest. That's the best interest rate, isn't it? Yes, it's the lowest interest rate. Great. And not only that, this financing gives you the lowest monthly payment, which you have to pay. But now see, Vivi, what we're going to do is we're going to do the note ourselves, and we're going to do it in the Vault software because there's a promissory note in there. And we're going to put these numbers into the Vault. And then what we're going to do is we're then going to make payments every single month back to your bank, which means after this 5-year period, you got the lowest monthly payment that was available. You got the exact car you wanted, $5,000 less. And now because you're making payments back to your banking system, you're going to get all the money back for this car because you're the bank. And not only that, all of your money, all 50,000 that we took out as a loan to pay for this car, all 50 grand of that still continue to earn interest. So if you're looking there, we could do that with a car. So now I taught my daughter some really, really, really important things about car buying. Something she's going to use and carry on with her whole life. Something then she will teach to her kids. Her kids will teach it to their kids. Their kids will teach it to their kids. But you see, we're not done there. We didn't set this thing up just to pay for the car. We set this thing up to also pay for her college. So here we go. We take 20 grand out each year for college. And I know some of you are like, wow, Chris, 17 years from now, college is not going to be 20 grand. Great. What does it matter how much it is? Even if it was 100 grand a year, we could do that. So we take that money out, but I'm just using 20. Then after that, she gets married. We need money for a wedding. A lot. I looked this up when I did this whole thing. Do you realize, and this is kind of sad, and maybe some of you did this, but you realize that most weddings, people take a loan to pay for the wedding? Like, think about that. You're paying for a one-day event. And granted, I know it's a memory, and there's a lot of things you could say about that, but it's a one-day event of a wedding, right? And both families have to pull into this, plus usually the bride and groom kick in some money. And I don't know who's doing this, but they're borrowing this money. They're literally taking loans, using credit cards or using HELOCs to pay for this wedding. There is no economic value outside of the memories you get from that. So we're not going to do that with Vivi. Vivi, whatever your wedding costs, there we go. We got a budget of 155,000 bucks. So what we're going to do is we're going to use up to 155. Now, also, Vivi, it doesn't matter that we paid for a car, for the college, and now for the wedding. You got $275,000 earning interest and dividends uninterrupted. This is what Stephen mentioned that he's thankful for. Uninterrupted compounding interest. But then after that, she needs a house, maybe needs a down payment. Hell, maybe she could just buy a house. I doubt it for 154 grand, but this is just one policy. Vivi now has two of these, okay? And she should have more. I'm slacking, but she has two policies now. And the other policy is bigger than this one. So you can imagine she's going to be able to afford a pretty nice house and she could probably pay cash. You know, one of the worst things you can finance is your home because the way the amortization schedule is stacked up, you pay the bank all the interest up front. You literally end up giving away, like, depending on what year you're at, as long as you don't go the full 30 years, you're usually paying an average of like 40 to 60% interest on your house because it's all front loaded. Vivi is going to do the exact same thing, except for her bank's going to get all that interest. So she's going to become wealthy through her own expenses that she would normally have in life. Her own debts and expenses are going to create wealth for her. As you can see this happening. Now with this, she's got a house, college, she's got a wedding under her belt, okay? She's got $334,000 earning interest uninterrupted. She's going to have kids. Her kids are going to need to go to school. And then someday she's going to want to retire. And you remember I talked about maybe we'll put money into a Roth IRA so she can have a tax-free retirement? We're going to do that. Vivi at retirement of 64. And does it matter if she's 64 or 60 or 50? No, because Vivi can take money out of this anytime for anything without having to ask permission. So can Vivi take money out before 59 and a half without asking the IRS any questions, without having to substantiate why she's able to take money out before the IRS is 59 and a half? No, she just takes it. Doesn't matter when she wants to retire. Well, let's see. She wants to retire at 50 while her kids' school is getting paid for. A lot of parents would defer retiring because they got to pay for college. Not when you own your own banking system. Remember, folks, this is just one $5,000 a year policy started for my daughter at 6 months. Are you seeing the compounding interest here? Here we go. At 50 years old, she's got $705,000. And she's taken money out. She's taken out at that point $240,000 so far. Never repaid any of it. Now, that isn't what you would do, but I'm just showing this as an example. But even if she didn't, and she took this money out at 64, she's got $1.55 million, 1.945 earning interest and dividends. She starts taking $90,000 out tax-free per year. And she does that all the way to age 92. We're gonna end it at 90 years old because I just had to pick a period. We could keep going, as you could see. We could take 90,000 out till 100 years old. She's still got $4.8 million, $8.3 million earning interest, a death benefit of 4.3 at almost 100 years old. But let's come up here to 90. Let's just recap what one policy for my daughter does for her. It funded almost everything in her life, or it could have funded almost everything in her life. I just piecemeal different things, right? We could add some stuff in there. And every time she finances something with her bank, does it hurt her or help her? Can anyone answer that? So don't you want that for your kids? Stephen, I know you use your policy for your son. I almost said daughter. I'm just in daughter mode today. But I know you use it for your son. So like, what are some of the things you do with that?
Yeah, absolutely. I mean, so we try and anytime we'll make a purchase for something outside of a gift, obviously, but I'm trying to think. Most recently, we got him a new a BMX bike. He wanted to learn how to ride wheelies. And so what we did is I think it was like $200, so not much money, but we literally, I showed him his policy and the balance. We took the money from the policy and kind of just showed him. And I know it's a smaller example, but, right now I'm just more focused on him understanding money doesn't come from trees. Like there's an infinite, there's a finite amount of it. And B, when you want to buy something, what's the best way to do that? So we'll talk about, hey, if I'm going to go buy a Jeep, I want to spend $6,000 on this little beach off-road Jeep right now. And so, I'll talk to him about it. Like, hey, I could go finance this and pay somebody else interest, or we can, look at this policy and we can use this. And I'll show him how we're recapturing it. And I've, recently been using the vault to be able to point that out because it makes it very easy to kind of show how the money flows. So right now, that's what I've been doing with my son. Nothing major, but just every small little transaction we do, I kind of just explain to him so he starts to grasp the concept.
I'm just telling people for years, we get to teach our families how to be the bank. We get to teach our families how to bank, literally, like banking principles. That's not taught in school. Last time I checked, nobody in the institutional side of things, whether it's education or corporate, nobody wants you to know how to be the bank. That's reserved for the bankers. That's reserved for the institutions. We're just supposed to be, just basically going and using the bank. We're not supposed to understand banking, but everything I just said and everything Stephen just said literally is us teaching our kids how to be the bank. Simple, basic banking functions. When you deposit money, little children, that you deposit it in your own bank, a bank that you control, a bank that you're earning the interest, a bank that benefits you, not into their bank. And also, when you take loans from your bank, which you will only take loans from your bank, because if you own a bank, why would you take a loan from somebody else's bank and let them earn interest on your money? No, you're going to take loans from your bank. But every time you take loans from your bank, you're going to repay your bank back the same way you would repay their bank back. Heck, if you even want to save yourself a little money to feel like your bank's better than their bank, save yourself some money. If Bank of America is charging 6% for car loans today, well, hell, our bank is charging us 5.5. We save 50 basis points. You see, when you own the bank, you make the rules. You're in control. And that's what we need to teach our families. I teach my daughter this. I just finally, after a decade, got my mom to kind of comprehend it. Even though she says she gets it, I still don't think she does. But she's making payments for her Chevy Equinox to her policy, not to them. She's no longer leasing. I finally broke it. It took a while, but I finally got her to believe in it. And I showed her the math. I said, Mom, if you pay your bank back $400 a month instead of their bank, after this period of time, 5 years or whatever the term was, all the money that you would have given to them, you will have all of it back, plus interest, plus dividends in a tax-free account. Any questions? Oh, and you now own the car free and clear. So she got it, but it took a while. Sometimes with our families, folks, boy, I'll tell you, there is no one more difficult than our own families. And the funny thing is, I guess I'm going to say I'm thankful that tomorrow we're going to be with family. And if I get asked, hey, what about this banking thing? I get to tell them, I'm going to be thankful that I get to try to teach people that probably I know deep down will never do anything with it. But at least I get to teach them and show them the glimmer of hope that this is possible. Do you realize that this is funny, Stephen? And I know you've gone through this. The other day, I had an old family member. He's since gone through a divorce with Larissa's aunt, but he's a great guy. And we're talking out front. And he was telling me that the family, and I probably shouldn't even air dirty laundry like this, but he was telling me that back years ago when he was part of the family, how they would always go up to him and be like, what is that Chris guy doing? How does he have all that money? Like, he's not doing, is he really making that much doing this be your own bank thing? They were like doubters. They're haters, right? Those are haters. But I'm super thankful for my haters, because haters need hugs too. Even if it's your grandma and grandpa, aunts and uncles, cousins and friends being the haters, they need hugs too. So give them the hugs. I'm thankful for that. Stephen, you got any family members that doubt you that you should be thankful for? You're kind of lucky. All your family gets this. I don't know how you manage that one.
I would not say that all my family gets this by any means, but some of my family gets this, and well, I shouldn't even say get this. I'll use my cousin who do a lot of real estate together. He has policies. He does call me still once, a couple times a year, and says, Stephen, I got to pay this premium again. Like, are you sure I'm doing the right thing here? I say yes, and he says okay, and he keeps it going. And I think just his last premium he paid, I think he finally started to get a little more, because he's at the point now where when he puts money in, the policy grows by more than what he put in. So now he's starting to see the positive growth. You know what I mean? So I think for some people, it takes different. I don't know. They have to see it to believe it. It takes time. Like I said, I mean, I was a hater and a doubter myself when I first started. So, it's very common. But again, at the end of the day, it just try and poke holes in this stuff. Like we challenge people, like show us how this is a negative. And here's the most beautiful thing about everything we do with infinite banking is you can is the and everybody can agree with this. The power of IBC, the power of infinite banking is the process. You guys hear us say that all the time. It's not the product, it's the process. But here's the beautiful thing about that is even if you never even use the process, you never even practice the infinite banking concept, you're better off with that whole life policy for you and your family than without it, even if you never actually use it. So start the thing, even if you can't commit the time to learn it yet, even if you can't commit the time to use it, which takes 2 seconds, but let's just pretend you can't. Get that thing in place because the sooner you start it, the sooner compounding interest kicks in, and compounding interest works off of time. So the sooner the better.
I just put this up on the screen right in line with what you were saying, Stephen. Sometimes I like, showing numbers because like, listen, that's really what it comes down to is the math. And it brings me up to, I got a super, super good friend and he's been my friend for a long time. God, I've known him since I was like 16 years old. He's an incredibly successful man. Him and his family moved to Florida to get out of the New York mess here. And every single year, I started a policy for him 6 years ago. Okay. And it was a good size policy. And every single year, like clockwork, in October or November, I get a call from this individual. And every year it's a review call, which I'm more than happy to do, thankful to do the call. But every year he's questioning, like Brent was, am I doing the right thing? Like, it just seems like this thing isn't doing anything. Seems like it's not growing, blah, blah, blah. It's always some negative thing, right? Because like I said, when we talk about money, what are we always talking about? Stress, fear, or shame, right? So he was like, am I doing the right thing? Shame. Is this really working? Fear. Should I be making these premium payments? I don't know. Stress. So like, here's the math. So how I do it, and I do this every year for this client, I'm like, you're doing the right thing. The policy's doing great. He didn't take loans from it up until just now. He just took a very large loan because he has a huge business opportunity. And, thank God for that, right? Like he went 6 years without ever taking a loan. How he looked at it, he said, listen, it protects my family. He's got a big death benefit, like over 10 million. It protects his family. Okay. So that's a big thing. His family's everything to him. But also he was just like, it's going to go and sitting in the bank account and I'm only going to make a couple of percent there. So this is better than the bank account, right, Chris? So every year I had to confirm that this is better than a bank account. So forget about the loan that he took this year for the business opportunity. Every year I would go in and I would show him this thing. And the first year is always the worst year. So let's just say this is my friend. And we're just going to call my friend Speedy Gonzalez for all intents and purposes. My friend puts 111,000 in. And in the first year, and in that following November, when his policy statement comes out, he gives me a call and says, Chris, am I doing the right thing? Should I make a premium deposit? I just don't know. And he's looking at it, he said, Chris, I put 111,000 in and I've only got 101,000 in this particular example. And folks, your example may differ from this. I'm full transparency. Everybody's example and design is going to be different, but I'm just using this as just an example. 101. So he's only got 91%. So I said to him, all right, Mr. Speedy Gonzalez, yes, this thing still makes sense. Remember, yes, you don't have 100% of what you put in because there is a cost for this death benefit. You got a $1.3 million death benefit should something happen. That's still not a bad price to pay, $9,172. That's what the total cost in the first year was for this. That's about what you'd probably pay or close to what you'd pay to buy a term policy in the first year. But hold on. The next year, same thing happens. Makes his premium deposit, 11 grand, just hypothetical. He puts way more than that in. And then we go over and he's like, I put 11 grand in and my policy grew by 11,729. He should be excited about that. But because he's not taking money out, that didn't get him. What he was looking at is he's like, wait a second. I'm still down $8,443 from what I put in. To which I then go in and I say, yeah, but you got $1.361 million in death benefit to protect your family. Plus, you've got $113,000 earning compounding interest at a rate of X. And I think the rate was 5.9 with this company. He was like, okay. And I'm like, your total cost up to this point is 8,400. Still about as much as you'd pay for term insurance at this rate. And every year we do this. Next year, same thing. But now I got to tell him like it's only 7,000. And hey, listen, that 11,000 you put in this year earned you 12,342. And we go all the way down. Here we are. Year six, or actually, this is just year five, but let's jump down to year six. Year six, my friend Speedy Gonzalez puts $11,000 in. Just yesterday, I get on the phone call with him. Hey, how's that policy doing? I haven't really looked at it. Like, give me the numbers. How's it doing? Well, Mr. Speedy Gonzalez, your policy's doing fantastic, like I said, every single year. You got $182,000 in cash value in the policy. The $11,000 premium you put in made you $15,461. And since the day you started this till now, your family's been protected. And as of right now, 1.4 million. Granted, it's going to drop here. His policy, his term doesn't drop till year 10. So he's got more than this one. But this year, he's got $1.4 million. Oh, and by the way, you made $5,727 since you started this program. And next year it's going to be 12,000. The year after it's going to be 20. And the year after it's going to be 29,000. And every year for the rest of your life, you're going to have more money than what you put in by X amount. By the time you're 71 years old, you've made $111,000. Your current money that you're putting in is a 350% return on your cash on cash return. Oh, and by the way, your family's still protected. We doing all right by now? The reason I do this is I know our families can be tough, but we got to be grateful. My good friend here, Brad, one of my best friends, he is very thankful that I set this up. But it took me 6 years of every year reconfirming, going through the shame, the fear, the stress of why am I doing this? What did I do this for? To now, he has this big business opportunity, needed lots of money, like over 500,000. And he's like, hey, do I have enough to take? This is how he didn't even know. And he just says, I need this much. Do I have enough? I said, you have more than enough. But I will process that for you right away. Let me send you the form because we need a paper wet signature because this is actually a large amount of money we're taking. The insurance company wants to make sure you're protected. So we did that and we submitted it, right? Did he have to ask permission? No, kind of. He asked me, does he have enough? He had more than enough. That's the only permission he needed, is to know, do I have enough? How much better is that, right? Why aren't we teaching our families this? All right, let's keep going on, Stephen. I love this one. And in light of where we're going to be and kind of what we talk about a lot is, we don't have to panic about market crashes. We don't have to worry about volatility of the markets. If the wind blows wrong, if a war starts, if China does this or Japan starts raising their interest rates, jeopardizing the entire world economy. Just because Japan decides to start raising interest rates, the whole world is basically in trouble of having the markets crash because of this tiny little country called Japan. Doesn't matter. Don't even get involved in that. But nonetheless, we don't worry about any of that. Stephen, talk a little bit about why we don't worry about market crashes, why we don't worry about changes in interest rates or any of this stuff, or even inflation. Like when inflation was running rampant, did we worry about it? Not really. We just had to get our money working.
Yeah, it's a beautiful thing. And it really starts to make sense also when you understand what this policy, what this vehicle is and what it's not. And there's a lot of confusion around that, especially when you're new to learning about this. I mean, Chris, how many times do we hear from somebody, oh, well, I'm not going to start the policy because I can just take my money and put it in the S&P 500 and make a lot more money? How often do we hear that? All the time.
All the time. Pisses me off. But I'm thankful to be pissed off at that question.
Yeah, or I can take my money and I can buy this real estate, and they're completely missing the entire point of all of this, because again, the point is to put the money into the policy, have it start compounding simultaneously, borrow the money out of the policy to go do that other stuff also. And that's why, like, our friend Caleb wrote a book called The And Asset, because that's exactly what this policy, what this vehicle is. It's the and asset, because we put our money in and we go do this other stuff with it. Now, the reason why, regardless of what the markets are doing, why it doesn't matter is because I'm going to personally control my investments. So when I want to take on risk, I'm going to take my money from a policy and I'm going to go put it into something. Okay. Whether that's a real estate deal, whether that's another piece of property, whether that's another business. Maybe I'm trying to be ultra risky and buy some crypto with it and play the markets or do some day trading, which is all things I've done in the past, right? And so regardless of what the markets are doing, I know that my core foundation of my money, where it's held, where it's stored, is in this policy. And that policy is guaranteed to grow per the contract. It's guaranteed to grow each and every single year for the rest of my life. The markets could fall in half tomorrow. The economy could crash. We could go into a recession. I know my money is safe in that policy growing. Okay. And when we look at history, the companies, the insurance carriers that we use, the companies we use to do these policies, they've all been around for 120, 150 plus years. So they've weathered the storms in the past and they know what they're doing. So we go back and we'll say, okay, well, how did, for example, One America or Lafayette Life, a couple of our favorite carriers, how did they perform in the 1930s during the Great Recession? How do they perform in the 2000 dot-com crash? How do they perform in the 2008 financial collapse and things? They all performed incredibly well. And there's a number of reasons for that, Chris, and you can get into some of the economics and financials if you want, but insurance companies inherently invest for the long term. Why? Because their product is a very long-term product. It's a whole life insurance product, meaning they know they're going to have to pay it out at some point in the future, but it's probably going to be 20, 30, 40, 50, 60 years down the road. So they look at their entire business model very, very long term. So they invest in very conservative asset classes, a lot of like bonds and treasuries and things like this that are kind of the inverse of these market crashes. And in conjunction with that also, when interest rates boom, insurance companies tend to even do better because of the way that they, again, the type of investments they do. So everything in a typical economy or your typical financial traditional way of looking at markets, insurance companies are almost the opposite of that. So, I mean, there's a few reasons right there, Chris,
I
why
love
when
it.
things go crazy out there, why it's all good in here.
Yeah, we always say the crazier it is out there, the calmer it is in here, and that is the God's honest truth. I mean, listen, it doesn't matter if it's the Great Depression, the Great Recession, COVID. Our accounts go one place, and that is up. Never ever can they do anything other than go up. Yeah, like I don't know many other accounts that can say that. Maybe you can say, "Oh, my bank account." Yeah, but they can change the rate, and if you're earning zero, you're not going up. You're actually losing to inflation. Oh, what about a CD? Well, CDs float with rates too. So you could have a CD earning less than 1%, then you're losing to inflation. In these policies, the only time you're going to have issues with these specially designed whole lives is in those early years where your compounding hasn't gotten to the point where it's enough to overcome the cost of insurance for the death benefit. But as I showed you in that one, it was 5 years. So most of the policies are anywhere between 3 years and 10 years cumulatively to completely break free. But the cash on cash return, like every dollar you put in each year, the return on them, usually that break even, we call that the efficiency point, is year three. So that's it. And then so I always ask people when we're talking about this, Stephen, and I think this is important. This is family too. Would you be willing to give up a little for 3 years to make money guaranteed for the rest of your life, never having to ever invest or do anything? Would you give
Yes,
up 3 years of gains to make money for the rest of your life, guaranteed?
I
And
would,
if
yes.
somebody says, well, I don't know, then I know I'm not working with them. And usually when I ask my family, well, I don't know, that depends. Well, it depends on what. Clearly, we're not gonna be able to help you because you just keep putting your money in the bank, keep doing what you're doing, and I hope it works out. You know what? It won't. It won't. That's the fact of the reality. You cannot save your way to wealth. Your money has to be working for you. Why is it that banks don't just take your money and put it in the vault and leave it sit there? It's because they know to be building wealth, money needs to be moving. It needs to be working. It needs to be out there earning. You can't make it if all you do is save. But yeah, what is most of the population? Okay, let's just talk about the US. Most of the US population, what are they taught to do? Save money. Save money. That's it. Put money in a 401k, hope and pray. Save money. Save to your retirement. And then what does life look like from the age when they start working? We'll call it 30 till 60. And most people, it's a bit of a struggle. The ups and downs, the hard times, the struggles, right? It's because we're not taught how money works. I don't mean to make that the sole thing, but that is a big thing. A huge reason why most American families go through their working years struggling. Not all, but a lot. Statistics will show a lot. None of you on here, but I'm just saying most people struggle because they're not taught how to be a good steward of their money. We never, ever learned how to be a good steward of our money. It's that simple. That's what we're teaching you here. We're teaching this by teaching you how to be thankful for the things. We're just talking about what we're thankful for with IBC and these policies. But like Be thankful that you're learning how to be a good steward of your own money, because then you can teach that to your kids and your kids to their kids and their kids to their kids, and you get it, right? IBC, the infinite banking concept, gives you a real duplicatable and repeatable system that is not complicated. I know in the beginning it seems complicated, but you know what? We created the Vault software so that it's uncomplicated. All of you, I bet you any money, if I took all 100, what do we got, about 115 people on here? If I took all 115 people of you and I put an atlas in front of you and I said, show me how to go from Buffalo to New York City, it would take you some time. You'd have to sit there, plot it out. You might not even know how to read a map. You might even be like, I don't know how to do this. But if I asked you how to go from Buffalo to New York City, and I gave you a destination in New York City, you would grab your phone, you would put your address, that address in your phone, and be like, oh, Chris, here you go. Here's all the different places you got to go. Or you can just hit start and it'll take you there. We created that, called the Vault. You don't need to learn all the stuff on the atlas like we used to have to do. You just enter your destination. What destination is it? I want to be out of debt faster. And I don't want to work harder, longer, or take on more risk. Great. We can solve that problem. I want to get all the money back from my cars and my tractors and my lawnmowers. Great. We could solve that. I want to make money twice on every dollar. I want my money working smarter for me. Great. We can solve that. We can do all that because we created the GPS for infinite banking, changing the industry. So I'm thankful for that. I'm thankful for what Craig did and what Alan did and what Stephen and the team do every single day. You see, we've been doing this long enough and we've had thousands of people do this, that we've generated the wisdom. Remember in the beginning, I talked about knowledge. That's where it starts. For some of you, this is the first time you're seeing that. There's a whole bunch of firsters, right? First timers. That's knowledge. You're getting knowledge, but application of that knowledge will create wisdom. Experiential, experience going through this and doing this will create wisdom. Or you just get one of us on the phone. Stephen, a bunch of people earlier, and I was messaging them, they were asking, can I do this? Should I use my HELOC to do a dumping into the policy? Should I use my, money in my 401k to do this? To which I said, no. So could you put a link for people to book a call? Because I know some people are asking for it, and I don't want to make them wait till the end if they got to run off, because they got to go get a turkey or do something. And then, folks, we're going to hit all your questions in just a second. I'm almost done because we are now at number 7. So we're moving along pretty quick. All right. This one's easy, and I'm not going to spend much time on it, but my goodness, am I thankful that I never have to pay taxes on any of the growth inside my policies. Like, do I need to say anything else with that? Okay. It's one of the most underappreciated gifts of the life insurance world, of whole life insurance, of the infinite banking concepts. The internal growth of our cash value in these policies is tax-free. As long as we design it for you, we will design it so that your policy will remain tax-free, the growth. And it grows tax deferred. So it's kind of silly because if it's tax-free, it doesn't matter if it's tax deferred. But if I really want to make this sound flashy, oh, look at this fancy smanchy whole life policy. It grows tax deferred and your income and gains and capital gains and everything are all tax-free. If it's tax-free, it's tax-free, it's tax-free. That's it. Most underappreciated gift of what we do. Sometimes we don't talk about it enough. Free access, tax-free legacy. Oh yeah, the death benefit passes on tax-free, and tax-free growth. Need I say any more? Yes, I'm going to say a little bit more. Also, it bypasses probate. Also, it's protected against judgments and liens in most states. Also, it avoids capital gains. And also, it keeps families in control of their money. Can I get an amen on that? I don't know.
Amen.
All right, let's keep going. Debt. With this system and with the vault, we now have a way to literally turn your debts into wealth. Because I always say it, I said the fastest way to wealth is through your own debts and expenses. And if you learn and use the infinite banking concept, even if you use just the vault because you don't want to learn the infinite banking concepts, you will create wealth through your own debts and expenses. Stephen, do you want to talk about that or should I just draw it?
Draw. Yeah, let's do some drawing.
So simple. Let me just draw because I haven't even used this poor board all day. So let's see. Let's get this thing up here. And I'm just going to draw a very simple system that all of you can see. All right. So over here, we know we got our whole life. And to do the infinite banking concept, you got to change one thing. So one change, and that is where your money goes first. Instead of going into their bank, you're going to put it into this specially designed whole life insurance policy. Now, that isn't where this problem is solved. To my friend, right, Speedy Gonzalez, this is what he did. He put money in here because he said it was a little bit better than his bank. It was better because it was tax-free. It gave him a death benefit for his family, and it earned a higher interest rate guaranteed than his bank. Okay, that's why he did it. And he also liked the dividend. Even though he didn't fully understand it, he liked the idea of getting a dividend. But he just kept the money in there. But for most people, that's not what we're going to do. We're going to come over here and we're going to find the fastest way for our money to grow a second time. We want to make money on our money twice. Every dollar you earn, I want your dollar to make money for you 2 times. One time over here, compounding interest. Okay, so this is your first place your money's making money. It's compounding interest. There we go. Number 1. Let's put a big number 1 here. But the second place we want our money is over here. Now, for most families, that is debt. So let me just pick on credit cards because most families have credit cards. So we're just going to do this. These are your credit cards. And let's just say you have $10,000 in credit card debt. That $10,000 in credit card debt every single month is costing you, let's just use simple math, $500. Probably be a little bit more than that, but let's just say $500. And that debt from that Visa is charging you 20%. So those are our numbers, okay? We got $10,000 in credit card debt. It's 20% interest, and you are paying $500 every single month to that credit card. This is your current scenario. Rinse and repeat, add your numbers, whatever you want to do. All we do is over time or all at once, we dump money into this hole. Let's just say they got money sitting in their savings. They got $15,000 in their savings account, earning 1%. They listened to what we said. They said, hey, Chris said just change one thing. So they take the 15 grand, they put it in the whole life. When they put that 15 grand in the whole life, let's just say it gives you 13,000 of cash value that can be used immediately. How fast is immediately? First 30 days. So immediately in the first 30 days. So then what we do is we take a loan from the insurance company to which you do not need to ask permission. You just go in and tell it how much you want. So you go online, you say, hey, I need $10,000 as a loan. The insurance company tells you it's going to charge you 5.25% interest, and that interest is only due 1 time a year at the end of the policy year. Okay, so we don't have any monthly payments on this loan that we took. It's just acknowledged that the insurance company is going to be charging us 5.25. We take that loan and we deposit that into our bank account. Yes, a traditional bank account, but this is a segregated bank account set up by you just for your banking stuff. So the 10,000 goes from the insurance company, and now 36 hours later or so is in your bank account. Great. So now what we do is we write a check or do an online payment to pay off this credit card. So now what we've done is we've taken a loan from our policy of $10,000, ran it through our bank account for books and records, and we just paid off the credit card. So we no longer owe the credit card anything. But we take the $500 we used to pay to them, and we pay the $500 to ourselves. Same 500, we just change the name on the check. That name on the check goes to you, okay? So $500 a month, you set up a bill pay, and that goes into your bank account, your segregated bank account. Then what we do is we fill out one form. The vault will do this for you. That one form then is a loan repayment. We call this recapture. So we're going to call this a loan recapture of $500 a month. So the 500 hits the bank account, and let's say that's on the 1st of every month. On the 15th of every month, we tell the insurance company, sweep $500 from their bank and put it back into ours. So now $500 a month goes back into your whole life policy. How much money do you have the next day? $500. When you made a payment on your credit card, if that payment was all interest, this $500, how much would you have available on that credit card when you made the $500 payment? 0, because all 500 went to interest on that $10,000 credit card bill. But now the $500 is going to your bank, so you now keep control of that. At the same time, what you're doing is every $500 a month that you put into the policy as a recapture is repaying the loan. So the 5.25% that is being charged on 10 grand is now decreasing while your full $13,000 in cash value is increasing because it's compounding. How do you build wealth through your own debts and expenses? That's how. You take back control of the money you're giving away. And you do that in a system that never fails you. And I just demonstrated that. Again, if some of you are like, that's too much for me to understand, I don't get it, great. The Vault. It's called BYOBVAULT.com. We'll put that in the chat along with a link to book a call. But if you do that, the Vault will run this system for you. All you need to do is put your debts in, put your inputs in, upload your policy in there. We will do some of that stuff for you. Okay. But this is how you build wealth through your own debts and expenses right there. Let's move on to the next one that we're thankful for. We already did this one. All right, well, actually, let's hit this one. Right.
Oh, hang on. Before you move on, let me just say,
Sure.
Brittany said, is there a way, sorry, if you guys put your questions in the Q&A, it's a lot easier for me to keep up, but she said, is there a way to use credit or debit or debt to pay debt without having any remaining debt with either debt? I don't know if I know what that means, Brittany.
Holy cow, please read that again. Wow.
Brittany said, what are some ways to grow with zero, no income, no savings? You're going to need to budget. You're going to need to find out how to get your expenses down so you have an ability to save even just a little bit, or leverage if you own
job, side hustle. Got a way to,
yeah,
make
or
more,
leverage if
spend
you
less.
have a home or you own a home, you could always possibly pull some equity, use that line of credit, something of that nature.
Yeah, Joe had asked also, do we deal with companies that will insure a 60-year-old? Yes, every day. Most of our clients are 60s, but not one without a medical exam. So every insurance company that we would ever deal with is going to require a medical exam. All right, let's keep going with this. All right, we don't have to, so you already mentioned this, so I'm going to really hit this. Caleb's book, The And Asset, really covers this. We don't have to decide where to invest our money or where to save, right? Because a lot of times when people come to us, and usually it's financial advisors, why would you put money in this whole life policy when you can make X amount in the S&P 500? What the advisor is doing is comparing this or that. Their client, are you going to put money in this whole life and make this, or are you going to put money in this and make more? You see, what you need to understand, it's not a matter of this or that anymore. And I'm thankful that we don't have to make decisions. It's this, the policy, and that, the real estate, the commodities, the futures, the S&P 500, the fancy dancy stock, the Bitcoin, whatever it is, it's this plus that. Remember, your money just starts here where it earns uninterrupted compound interest. Then it goes to work doing whatever. Replace debt for investment, replace investment for real estate. This is just your opportunity. You make money twice, not once. That's all I have to say about that. Anything you want to add on with that?
Mm-hmm.
All right, we're getting to the finish line. All right, we are extremely thankful that we're not chasing returns anymore. I got to be honest. I've gone through a lot of phases in my life where I've been lured into deals because of high interest rates. And I'm sure many of you are there, and I'm sure many of you are in the same deals I am. We were kind of lured in by a fancy return, a high return, a almost unbelievable return. And a lot of those deals, well, didn't quite work out the way they should have. Now, we're hopeful and thankful that we learned what we did through those, and we're hopeful that we'll get the money back, and very well, we probably will, but we had to learn. But we were lured in by high returns. You see, through knowledge, which is facts. Facts are, I made bad decisions in the past, and I learned doing that, which has created wisdom. And now that wisdom tells me, hey, listen, I no longer need to chase the big returns. I need to just go after the steady, consistent, predictable returns that I can get every single year and just do that because my money's continuously working for me because we don't need to chase those returns anymore. And how I have this written, or how Shauna wrote this down, she said, people get trapped. They get trapped into chasing the next 10%, the next crypto boom, the next stock. But what if your system was your asset? This system, that's the only asset you need. And then you just keep moving your money around it. Yes, sometimes these will be investments which will involve risk, but you don't need to chase the return because you get to make money twice, not once. So you can make less and still make the same. And in a lot of cases, back to the tax thing, even if you're making just the money the policy pays you, it's still more than what you'd make in any other taxed investment like a brokerage account, a CD, a savings. See, often a lot of people, they don't factor in that, yes, I might be getting a higher return on this thing, but I got to pay tax on that return. I might be getting a slightly lower return on the whole life policy's internal return, but I don't have to pay tax on that. So what you do is you find a calculator, an after-tax equivalent yield, and you can see, like here, I want to do this because I've never done this on here and I got a minute or two. So let me show you something. All right. So give me an example here. Let's say you've got a municipal bond yield. We'll call this because municipal bonds are tax-free, right? So let's call this a 6%. Actually, let's do 5.9% interest rate because Lafayette Life just increased their dividend crediting rate. I know a bunch of you have Lafayette. They're 5.9. And let's say you got $100,000 with a state income tax of, I don't know. Well, let's just leave it at zero because some of you are at zero. Let's calculate this. All right, so 5.9%. Let's say this replace municipal bond yield with whole life insurance policy. You make 5.9%. How much would you have to make in another taxable account at, even if you're at 0% state tax? Right here, 7.564. Hold on, let me show you something. What if it was only 3% after cost of insurance? Here's 3%, 3.846. I'm just trying to show you, like, no matter what you do, if you made 10% on a policy, not that you would, but let's just say, you would have to make in a taxed account 2.82% more. And that's assuming you have zero state income tax. Like I'm at like 8% state income tax, which means I'd have to make 13.93. I've never shown that.
That's the beauty of investing in a Roth IRA, though, a self-directed Roth IRA. I mean,
it is. Or municipal bonds. In that case, that's what that was showing. Or stupid whole life insurance, like we're talking about. So it works the same. I'm just trying to show you, like, I'm not making this stuff up, folks. Like, that calculator is available to all of you. So use it. So we're not chasing returns anymore. And, you know, wealth can become boring again. I know wealth isn't boring, but you can make it boring. The building of wealth can be boring. All your friends can chase all the returns. Let them go out and chase the big returns. And you can do it a little bit with money you can afford to lose, but why don't you just become boring? Why don't you just make consistent, predictable income every single year without any risk? That's what we're talking about here. And the very last thing that I want to hit, Stephen, and I'll let you kind of fill it in, is I am sincerely thankful as we go into Thanksgiving that we get to help others take back control of their money. And I think that's one of the most powerful things we do. We show folks and families and all of you how to take back control of your money. And then you go and you show those that you love how to do the exact same thing. And then that compounds. And that's where we get into that compounding effect. See, compounding doesn't just involve money. It involves knowledge and wisdom as well. So as you learn these things, as they're applied in your life and you start to use them and have success with them, you then tell others about it, which then compounds what you learned and allows other people to benefit from that. We've been doing this now for, I think, over a decade. I'd have to go back and look, but total over a decade we've been doing this, and we've helped thousands and thousands of people. And I am just so thankful. It's almost a mission at this point. We are on a mission to help more and more and more people. And we're doing that by making this easier and easier and easier to apply through technology, through the use of artificial intelligence, agentic AI, and all these different things, so that all of you can just do the GPS, punch in the destination, and boom, it directs you where you're going. Stephen, anything you want to say as we kind of get to the final stages of this wealth webinar?
no, I love that. You know, knowledge compounds, education compounds. I mean, you know, when you first kind of run across what we do with Money School and BYOB and Private Money Club, you know, and when I try and explain it to somebody for the first time or even teach it for the first time, there's so much. I mean, it really is a lot and it can feel overwhelming. And so you just need to kind of break it down piece by piece. So where do you start? You know, where do we start first? Well, for most people, starting first is watching a couple of these webinars, watching what we call the 90-minute IBC training to fully understand the concepts. And then, you know, once you kind of have that base, you know, a couple hours of information, then get on a phone call with our money mentors, because we have a process on that call with you. And I'm going to recommend doing a video call. So that way you're on, like if it's with me, for example, you know, it's you and me one-on-one on a Zoom call. So we're talking, we see each other, we can understand each other, we can share screen. So we've designed this initial strategy call to literally take you from being like a little baby, you know, that doesn't know anything, be able to answer some of your questions, start talking about your situation. And by the end of the call, you actually see a clear path exactly how this is going to work. So we have the tools that we can share. That's why I recommend the video Zoom call or a Google Meet call, because we can share screen, show you your situation in the vault, show you whatever that problem is we're trying to solve, whether you're looking to pay off debt, whether you're looking to finance things, whether you're looking to grow wealth, we can show you this stuff. So we have a really nice way of doing that. So start with that. Start with scheduling that call. And I'll put the link in again right there. Before the call, watch the training that's on that call link. Just click and watch that video first. But get on that phone call, get on that video call and start there. And then we can start recommending to you other resources, other books, other webinars, other trainings. We started in 2020 teaching what we called the Money School Essentials 3-day virtual training event. And it was a huge success. A lot of you on this webinar still today probably started with that 3-day Money School Essentials training event. We drifted away from it in 2025. This year, we didn't do them. We did a couple other virtual events a little bit differently, but we're bringing it back. We've learned what we did in the past. We learned what we did this year, and we're bringing it back better than ever in 2026. So put it on your calendars right now. January 30th, January 31st, and February 1st is going to be the new Money School Essentials BYOB Blueprint 3-day virtual training. It's all new content, all new teaching. It's some of the same foundation and basics, but a lot new spin on stuff. So I'm super excited to bring it back. It's going to be better than it's ever been before. So if you're really new to this, get a ticket. And the reason I'm bringing that up right now is on Friday, you're going to be bombarded on your email with Black Friday offers and throughout the weekend for Cyber Monday offers. Keep an eye open on your email for stuff from us, from BYOB, from Chris Naugle, from Money School, because we have a Black Friday, Cyber Monday offer for you to get a ticket to that virtual training. That's coming at the end of January. So you're not going to want to miss it. It's going to be the cheapest you go. It's going to be like $40 or something, guys. It's very inexpensive. But those 3 days virtually will literally change your life. And we record the entire thing. You can go back. We give you the recordings for life. You can go back and watch them over and over again. But those 3 days will literally change your life. So if you have to start somewhere, get on the call, get your ticket for that 3-day. And I promise you, I guarantee you, I will personally give you your money back if you don't find that training the most valuable thing you've ever sat through all year.
I'll give you your money back too. So you'll actually make money on your ticket.
All right.
Actually, that's kind of a cool. We should do that, Stephen. For this 3-day, like put a guarantee on there, a money back guarantee, but you'll give them their money back and I'll give them their money back so they'll make money on it. I bet you any money, nobody would request their money back.
I created this training, so I will stand behind it 1,000,000%. So yes, absolutely. I'm game.
All right. So I'm going to hit Paul's question in a second, but I just want to give a shout out from the entire team. So Shauna kind of wanted to give thanks for our whole team. So it wasn't just me and Stephen giving thanks. Stephen said, or Shauna and our team wanted you to know that we are thankful for the clients who trusted us over this year. Wanted you to know that we are thankful for all the calls we've done in the real lives that we've seen shift, and that we're thankful for the PMC and MSTV crew, our team, our podcast listeners, our YouTube listeners, and every single one of you on this movement. And then basically just ask all of you, what are you thankful for? Big, small, or indifferent? And then the last thing I'll ask as you guys put in what you're thankful for is I just want to hit this question up here for Paul. When you prioritize the client's financial well-being over your own commissions, you are basking in the smile of God who makes the doctors swear first, do no harm. That's interesting. Thank you so much, Paul. Yeah, I don't think a lot of people realize that. Like, if you just follow common knowledge of the insurance world and life insurance, you would think that whole life insurance pays these big commissions. And you know what? That's not a lie. A regular whole life insurance policy designed on true just base, the one that most people would buy before they learned about this, it does. It pays a big commission. And I'll just show you, just so you all understand that. Let's just say, because somebody was asking about $100,000 premium. Let's say somebody put $100,000 premium into a policy at a New York based company. I'm just going to use New York because that's where I'm at. The commission would be 55%. Okay. So
well, and even that, Chris, sorry, even that, there's a lot of caveats. Like that 100 grand, if that's a dump in, it's a lot less. Like,
well, let's just say this is 100,000 into base premium. So let's just say somebody
huge policy.
Yeah, it's a big policy. But sorry, so let's just do a 10 grand.
Because that wouldn't be base. I mean, 100,000, you're talking probably 30,000.
I'm just doing a regular off-the-shelf whole life policy.
Okay, fair enough.
This is just an off-the-shelf whole life policy. Like, you just go to your financial advisor, you say, I want to buy a whole life policy. They do one for you. it's 10,000 in premium. They're going to get 55%. So they're going to make what did I do? 5,500. Changing my numbers here on me, Stephen. So 5,500.
That's
Okay.
more realistic. Yeah.
Now, let me show you how we would do this. Let's say we did that exact same thing, but we would not build the policy the same way. So if we just did, let's say our most common, which is 75% goes to what's called a paid up additions rider. This is our most common design that we do. So many of you have this. That means out of the $10,000, $7,500 goes to this part. 25% goes to the base. Okay, so that's $2,500 of the 10,000 goes to base. We get paid 55%, just like I showed you of this. The 7,500, we get paid about 2%, give or take with carriers. Steve, I'll just do the math real quick, Stephen. I'm going to do this live, so I didn't have this pre-done. So let's see, 7,500 times 2%.
I don't even know if it's 2%, but
it's not, but let's just do that. Okay, so let's just over here, we're going to do the commissions over here, just because I ran out of space on that side. So here's the commission. You guys can check my math. 7,500 times 2% commission would be $150. 25%, which is the base, that's 2,500 times 0.55, 1,375. So 1,375 plus 150, $1,525 versus $5,500. Those are the differences in commission. Okay. Now, if you did it monthly, it would be divided by 12. So we would get, so let's say you did a monthly premium, we would make $127.08. You know what? Over here, they would make 5,500 divided by 12, 458. That's almost the car payment. So you can see the difference. So when you look at the commissions, and this is kind of what I believe Paul was talking about in his comment, that is your difference. This is how we design them. I mean, it's always going to vary. It can go as high as 90 and as low as 10, but this is, I just did an average. This is what we'd make, 1,525 versus 5,500. The difference, guess where it goes? Your pocket, the cash value. That's the difference, folks. So when we're talking about we take less in commissions, I mean, listen, like if you get on the phone with one of our mentors and you're talking and you're concerned because somebody said, oh, they're the only ones going to make any money on this thing, have the mentor show you how much your commission or how much the commission will be. You'll be drastically surprised. I get the commission statements. I look at them. I can't tell you how many lines I look at that are literally $1.50, you know, $10, $25. I've even seen them in the pennies, like 50 cents. Because if somebody's paying monthly, like literally it's all broken down monthly, like it doesn't take long to get down to like 20 bucks a month. So the thing that matters here that I'm trying to instill is it's not that we don't make a lot of money. I don't hide that. Like I'm not sitting here hiding behind, oh, we don't make a lot of money. We do, we make a lot of money because we do this for thousands and thousands and thousands of people. But because the commissions are so low per case, what you have to understand is we're not doing it for the commission. The commission isn't the driving force for us. Trust me, we'd all go broke if that's what we did. In the normal world of financial advisors and insurance agents, they live and die by the commission because that's what they feed their families on. Here, we live and die by solving thousands of people's problems. That is the only path for us. It's the only way we can do what we do, and it's the only way we can grow. So I think that really aligns us with our clients' needs and goals. And that's why it's so important that all of you are here because you're learning something new. You're gaining some knowledge. Now it's important that you take that knowledge and turn it into wisdom. You can do that several different ways. Book a call. We'll put that link up again. Go on the vault, play around in the vault. Just, see if you can, in the vault, even without paying a penny, you can go in and you can see how fast it would pay off your debts. Okay, that's a feature that we made. It's called the Debt Blaster. And once we do that 3-day training, by golly, get your tickets for the 3-day Money School Essentials. And like I said, I think we're going to probably start promoting it. And when we do, Stephen will guarantee that if you don't like it or you didn't feel like you got something, he'll give you your money back. I'll give you your money back as well. So it's a 2-for-1. Sound good, everybody? All right. I know we went a little over, so I wanted to say happy Thanksgiving, not just from myself, but from this entire team and from my family to yours. We'll see you guys on the next one.